Yeah, so these earnings are coming out. Just give us your estimates. Let's start there.
Yeah, sure. Well, for the full year, we're expecting that there will be 8% decline in adjusted EBITDA for Alibaba for the fiscal 2023. This is because of investment in content. As we know, they need to compete with the short video platforms for content and traffic. And also, there will be more investment in cloud because it continues to be a very good market in the long run with a lot of potential. And also, we expect to see investment in after-sales services and logistics as well. And of course, the weak macroeconomics and the COVID disruptions is also the reason why we're forecasting a decline for the year.
Okay, so the outlook, I'm guessing, for next year, if the macro headwinds go away and some of these investments then come to fruition, you think this year's the bottom?
Yeah, I think you're right. So I think that basically, I would think that the June quarter should be the bottom. And we're seeing that from April to May to June, we're seeing some recovery in the online retail sales. We're also seeing recovery from in the China e-commerce logistics index as well. So we're expecting that this year will be the bottom, and then next year will be better.
Okay, understood. Now, I want to ask you, just as an analyst who looks at the stock here, news recently that the primary listing, the goal is to have it just here in Hong Kong. Does that have any practical implications for what you do?
Yeah, so Morningstar focuses on fundamentals, but obviously it's a big news because they will be able to be included in the Stock Connect program. So that will be able to help them to diversify their investor base as well. So, but then whether sort of A-shares investors will necessarily bump up or actually sort of reduce the valuation of the Hong Kong shares of Alibaba, in my view, is actually uncertain. I don't think it's necessarily true that they will bump up the valuations or the share price.
Okay, and from a fundamental perspective, you have a buy recommendation in the stock. I think it's 179 is your price target. You look at the multiple the stock is trading at, I think it's 12 times earning. The market's basically paying half of what it used to pay for this company, right? If you remove the risk premium and you simply look at fundamentals, do you still think this stock is undervalued?
Well, I think the stock is still undervalued. I think it would be a good sort of broader China consumer recovery play. I think that the main reason why the multiples is so low is because of fear of regulatory crackdown on Jack Ma affiliated companies. But probably more importantly, in my view, is the competition in the e-commerce market. The fact that it's actually closer to saturation. We're seeing that e-commerce penetration is now about mid-20s. And more importantly, the short-form videos companies are really doing really well in terms of sales or gross profit, GMV. So these short-form videos are registering more than 120% increase in the 618 festival. So that kind of gives a lot of pressure to the traditional e-commerce companies that are only registering about 1% growth. So I think this is the main reason. But I need to remind everyone that this is very well understood in the market, and in our model we have basically assumed that the market share will decline to below 50% after 10 years. So I think it's fully factored in my model.